Those were the headlines we'll be tracking for you all evening on ET now. But to talk about the first topic at hand, and I suppose we should replace it with another one that I'm sure many of you guys have opened the papers and read into. But yeah, I'm going to talk about both the topics. First is, of course, that big downgrade that has come in for Yes Bank, which may impact certain debt MF NAVs. And the second one, being the more recent one, the events that have transpired over the weekend with respect to the US-Iran war. I have with me Mr. P.V. Subramaniam of Subramani.com. Mr. Subramaniam, thank you so much for joining in. I know I'm deviating a little bit from, the subject, but yeah, I suppose today's market fall merits a mention on that topic, right? It's just at 12,000 for the Nifty and the Sensex as well, 700 points gone. I suppose Donald Trump has done it again.
Yeah, I mean, this was quite expected, right? The presidential elections are due. So he will want some patriotic fervor created in US. So this is not totally unexpected. In fact, there is enough evidence to show that whenever there is an international event like this and our market tanks, it's a fantastic time to be buying. And Mubina, you're young, you're going to be investing for the next 50 years. So you should be celebrating a fall and not be worried about a fall. I think it would be a great time to be buying and not a time to be worrying. This has got nothing to do with India. I mean, if you're worried about Indian conditions, that's a different thing. But because there is some bombing somewhere, we know it's just some kind of a game, and once the elections are over, things will come back to normal. So I don't think there's anything for Indian investors to worry.
Okay, stirring up nationalist sentiments just before elections. Where have we heard that one before, Mr. Subramaniam? But yeah, that's exactly the reason why I wanted to ask you this question, right? Essentially that many a times mutual fund investors tend to open the papers and read, oh, okay, you know what, there's an escalation in global tensions, markets have cracked. I think we should sell our, our funds or sell our shares because things are going to be looking bad. But no, if you're a long-term investor, there is really no reason why you should panic. In fact, take an opportunity. We often tend to call it a sale of sorts, which you should take advantage of. It's a limited period sale. So yeah, I mean, this is the time that, when the market falls, you should tend to buy in only and only if you are a long-term investor. But for those investors who are not so long-term, well, debt mutual funds is one such instrument that they could invest in. And that brings us to the other topic that we'd like to talk about, and that is the CARE Ratings downgrade of Yes Bank across all of its categories, be it infrastructure bonds, lower tier 2 bonds, tier 2 bonds, additional tier 1 bonds, perpetual bonds. All of them have been downgraded because they are worried about the future of the bank. So these are the questions we'd like to pose. Firstly, how closely should a unit holder look into the assets held by a mutual fund? Secondly, this is not the first time that a rating downgrade has hurt debt mutual funds. Like I cited earlier, the examples of the DHFL, Pramerica, NAVs that tanked in just a matter of one single day. So these are the two main questions that I'd like to pose to Mr. Subramaniam. So yeah, firstly, Mr. Subramaniam, how important is it that, a debt mutual fund holder who does have a time horizon in hand, obviously, because he's definitely not a long-term holder, how much, to what extent should he be looking at the constituents of his mutual fund?
Just because he keeps looking at his constituents of his fund doesn't mean he understands. Let me give you a simple example. If you look at the holdings of Franklin Templeton, they don't buy any Reliance at all in their equity funds, but they have Reliance in their debt funds. When you look at such data, how are you going to react to it? And I don't think Yes Bank you need to be worried, because the government is not likely to allow the bank to fail. So if you're an equity shareholder, yes, you should be worried that the prices will not come back to 400 and 500, which was there earlier. But as a debt fund, I do think that your NAVs will be recast once the repayment happens. Yes, if you have a time frame and you have, say, next 2 months you need the money or 3 months you need the money, that's bad luck. The company may not revive within that quick period, or rather the NAV will not revive. So to that extent, yes, bad luck. But I don't really know whether a person looking at the debt portfolios will be able to understand what to do with. See, reacting after Yes Bank has been downgraded is of no use. If you reacted much before that, then it's a different thing. But you may not have reacted because you just think it's another bank. So why do you react to Yes Bank like that and Axis Bank differently and HDFC Bank differently? Really, people don't know. And the market has also taught us one very bad thing, that if you buy bad quality but government bank, you don't have to worry because it won't get downgraded. An Indian bank balance sheet may be worse than a Yes Bank balance sheet, but yeah, it won't get downgraded because there's a government of India protecting it. This is really difficult for the common man to understand. If he doesn't understand, he should stick to ultra short bond funds or maybe bank deposits. The funds like the credit risk fund, etc., run a little more risk. If he understands that, great. If he doesn't understand, stay away.
Okay, so essentially, Mr. Subramaniam, even if it's a debt mutual fund, you don't advise that the unit holders should look into the constituents because, I mean, we do know what the news flow has been, right, for the last 1 year. Yes, bank is in trouble. You know what's happening with iBulls. We know what DHFL is. So that basic news sense, I suppose all of our all individuals were watching as well. And if you've been a good, viewer of ET, now you do know what's going on roughly in all of these companies. So don't you think even that basic knowledge, that precursory knowledge would help them understand that, oh, okay, you know what, the fund that I have has almost, XYZ percentage put in these papers of DHFL. So it's better that before things fall apart, I should move out?
Yeah, maybe, but the better thing to look at is the fund very concentrated in any of these things? Like, if there is a fund which has put 3% in 30 companies or 33 companies to be precise, then I think the impact will be less. But if there's a company which has put 20% and it has only 4 companies in which is holding or 3 companies in which is holding, though there the impact will be greater. But largely we believe that a bank will not get downgraded. RBI will always rescue a bank. So even if you had money in Yes Bank, you need not have worried so much, but in DHFL or maybe some of the ILFS constituents, you needed to worry. But is it something which he will know when to react? Will he react to it in advance? I mean, everybody knew that the equity portion of Yes Bank was falling or the equity was falling, but people never thought that the debt will fall. But yeah, debt has also been downgraded. Is it a good time to remove because there has been a downgrade? Again, it's doubtful because what happens if the money comes back because the bank got rescued, it got a new funder and things like that. So it's difficult. So I'm saying, so if you look at it, it has to be a very well diversified fund. Then you have to less to worry. But I don't think bank default in India is going to happen in a hurry. I don't think it's going to happen. So I think your money is safe. But yeah, time horizon is a problem.
Okay, so Mr. Subramaniam, I'm going to ask you directly, I suppose. I have a report over here that tells me that the Baroda Treasury Advantage Fund has almost a 24% exposure to Yes Bank bonds. There's the Nippon India Strategic Debt Fund that has 17% and the IDBI Credit Risk Fund that has 12%. So when you say that I have to look at the portion of the fund that has been put into any of these risky bets, if you could call it that, Yes Bank, DHFL, ILFS, so on and so forth, how much should be the percentage?
Yeah, this is too high.
Okay.
Definitely too high. But what happens is when I am a fund manager, I decide to take the concentration risk on a bank because I am assuming a bank will never default. So I would go and put money in an HDFC Bank, ICICI Bank, Axis Bank, Yes Bank, thinking they're all the same. But suddenly when a bank gets downgraded, then the 24% or 17% can look amazingly stupid because that's going to hurt that fund like mad. But you don't normally put such a huge percentage in a NBFC. Like you wouldn't put so much money in say a DHFL or things like that because there you're worried about the liquidity risk and the concentration risk. Here again the problem is the concentration risk and the liquidity risk is happening in the same thing. So yeah, these 3 funds are going to suffer like anything. So if you're a brave man, you go and buy. If you're scared, you just jump out. But I can tell you one more thing. During such times of fear, a lot of money gets transferred from the less knowledgeable investor to the more knowledgeable investor. So the more knowledgeable investor who think Yes Bank will be rescued will be buying, but the investor who is worried that Yes Bank will not be revived will be selling. So money is just getting transferred from one person to the other.
Okay. What about that FMP default? I mean, I would like to, jog our viewers' memories as well. And of course, the guys who did hold the FMP will not forget it. But it happened, I suppose, I think in the earlier part of last year, April or May, we did have one particular group defaulting, and hence the FMP as well, could not be paid out to the FMP holders on maturity. So from that perspective, should an individual be worried?
Yes. See, we have always thought that debt funds are like bank fixed deposits.
Yeah.
They are not. They are far more riskier, but they give you higher returns. So if you have held it for 5 years and you got 2% more, which means you got extra 10%. Now if you lose another 6 or 7%, you have to assume that you have lost 6% or 7% out of the 10% extra that you got. You cannot have the cake and eat it too. So if you want returns which are better than the bank, you run a little higher risk. But instead of paying tax on interest income, here you pay capital gains, so you will pay lesser tax. So it has some advantages, it has some disadvantages, but yes, look at liquidity risk, look at concentration risk. But any fund manager goes and puts money in a bank thinking bank will never default, and I don't think Yes Bank is going to default. Yes, there is a downgrade, there will be a fall in NAV, but if you hold it on for a long period, you don't have to worry. But if you were an FMP, there could be perhaps some side pocketing and you could get this portion of the money after some time.
Okay. You mentioned side pocketing, I think, and I think that's something that we would like to talk about as well, because that's expected perhaps, because usually when an instrument's credit rating falls, these mutual funds side pocket the exposure. So could you explain how that phenomenon occurs, and what does it mean for a unit holder if their fund has side pocketed their exposure?
See, what happens is if they don't side pocket, which means they have to downgrade it immediately. So what happens is if the NAV gets hurt, so the guy going out on that particular day will go out at a lower NAV because this whole 17% or whatever will be suddenly written down to zero, right? So which means there's a 17% hit on your NAV, and that's huge. So what happens is they keep the money aside and they say, okay, you can take the balance, and this, as and when it is recovered, we will pay you. The advantage for the incoming guy is also he doesn't participate. Like he comes in hoping that the whole money will be recovered. What happens if the money doesn't get recovered, or the money or the bonds are written down only 50%, and then he loses another 50%. So this is a protection meant for the incoming investor as much for the investor who goes out. For an investor who anyway is going to stay on in the fund for a longer period and wait for the whole act to play out, it doesn't really matter about the side pocketing. So side pocketing is largely going to help only the guy who is going out or the guy who is coming in. The guy who stays doesn't get impacted.
Okay, so folks, I hope you've understood this process of side pocketing that recently companies have been doing. And of course, in the case of those debt mutual fund holders who have Yes Bank, the mutual funds that have Yes Bank, and if you own the debt mutual fund, at this point of time, you really don't need to worry, because the whole point also of a mutual fund is the fact that you've diversified your risk. If you are holding the shares of Yes Bank, yes, you perhaps have reason to be worried. If you're holding a mutual fund, I don't really see a reason why you should be worried. Okay, well, on that note, I'd like to kickstart our Ask the Money Show segment, where we open our phone lines for you, the viewer. If you have any questions or queries with respect to your funds, the funds that you own, or even if you've not yet kickstarted your mutual fund journey, you can call in. The number will appear on the top of your screens, 24990300, or you can email us right away on themoneyshow@etnow.tv. Well, we received a couple of email queries, so I'm going to get those, going. First up, we have P. Revant Kumar, who has sent in a question. He writes to us saying that I'm a 27-year-old government employee investing in 4 funds. He's put in 2,000 rupees each. There's the Mirae Asset Emerging Blue Chip Fund, the Axis Blue Chip Fund, an Axis Small Cap Fund, and an HDFC Small Cap Fund. He's put in 2,000 each. So he essentially wants to know if this portfolio is okay. He already, by the way, has a national NPS basically. So yeah, Mr. Subramaniam, 2 small cap funds, 1 blue chip, 1 emerging blue chip. So do you think he should expand the number of funds that he has? And also, what do you make of the funds that he already owns?
No, I wouldn't think he should be expanding, and I'm assuming in the NPS he's taking some more exposure to equity. Which presumably is an index fund, so he's getting some large cap exposure there. He's got 2 small cap funds, so he should shift out of the HDFC small cap fund and go into the PGIM India Diversified Equity Fund, which is a multi-cap fund. That will give him all the flavors, and as and when he wants to increase, he should just stick to these 5 funds that he has, or these 4 funds plus NPS, and keep on increasing the amount. He should not keep on putting 2,000 and adding more funds. That doesn't really serve any purpose. So next year, if he's got more money, he should make it 2,500 or 3,000. Just stick to these 4 funds plus NPS, and he will have done well.
Okay, well, yeah, reminder for all our viewers, and NPS as well will have some exposure to the equity component. So when you're looking at your portfolio on a holistic basis, you must ensure that you consider an NPS as well. Okay, we have a very fun specific query coming in from Vivek Jaising. He writes to us saying, can you elucidate if the HDFC equity fund is still worth holding, or can I switch to another multi-cap? Again, he's not mentioned if he already does own any other funds. He just wants to know if he must move away from the HDFC equity fund. So, Mr. Subramaniam?
Yeah, a nice thing or a good thing, something has happened in the HDFC place, that one of the persons who is managing the HDFC funds has moved to PGIM India, and he manages a very small fund there, which is I think about 300 crores or maybe even lesser, and HDFC equity is a 23,000 crore fund, so he might as well experiment and shift out of HDFC equity fund into the PGIM India diversified equity fund. And that would be an experiment that he does, and he should be watching it very closely over the next 2-3 years, because in this space it is easier to manage a small fund than to manage a big fund.
Okay, so yeah, PGIM India, that's where we've received, that's where the HDFC AMC CIO has moved. A fund manager has moved to PGIM India. So you should perhaps keep your eye out on this AMC. It's a smaller fund, but let's see what sort of potential it holds now that there's been that management conclusion. Okay, Jayaram Jayakumar writes into us saying, at the outset, my sincere apologies for this silly question. Well, I suppose if you don't ask a question, you continue to remain silly, so it's better to ask of the question. He asks, assuming I hold direct stocks in a company in which my mutual fund also has some share, how is my holding percentage to be calculated? Assuming, I think both of us, I think I can assume his wife and he both have 5% of their portfolio on that. Okay, I don't think we've ever got this question, Mr. Subramaniam, but I suppose now even I'm curious. How is it calculated then?
See, first of all, when you're a small shareholder, you don't really have to worry too much, because we anyway over diversify. We are never very focused. Even if we put in an index fund, we want to put into Nifty, we want to put into Sensex, we want to put in a small cap. So we try all that. So here what he's talking about, I think, is, let us say he's got 5,000 rupees worth of Reliance invested, and he has invested 1 lakh of rupees in a mutual fund, which is also invested in Reliance to the extent of 5%. So how much does he have? So he has 10%, which means 10% of his portfolio seems to be in Reliance, but that's not true, because he could have other mutual funds, he could have other direct equity. So when you take all that, he doesn't have a very big percentage. So I don't think he needs to worry about it too much. But yes, his holding will be taken as 5% of what he holds and 5% of this fund, but 5% of that fund depends on how much he has invested in that fund. So if he has invested only 10,000 rupees, that is 500 rupees, and 5,000 here, so it's 5,500. And if his total equity exposure is something like 5 lakhs, then he's got 1%. 1% of his money is in a company like Reliance. As a percentage of Reliance, he's got nothing, so that he doesn't have to worry at all. As a percentage of his own holding, about 1% or 2% is into one big company, and that should not worry him. In fact, as long as he doesn't have ESOP and he doesn't have a very concentrated portfolio of say 20-25% or 50% into one company, he doesn't have to worry. If he's got 2% or 3% or 5% of his money into one company, he shouldn't worry. In fact, up to 20% he need not worry.
Okay, Mr. Subramanian, I have a follow-up question taking this into consideration and also a bit of the first question. Now, we tend to have exposure to equities in various ways, right? Like you mentioned, ESOPs, NPS, in some way or the other, we do tend to have an exposure to equities. So when I sit down and I'm doing my financial planning, and we do know, if you're young, then a bulk of your money has to be in equities. And as you grow older, then maybe the equity component can reduce and debt can start increasing. So how do I have to holistically look at my portfolio? Do I have to sit down with the NPS component, the PPF, my employer's provident fund, and then of course the mutual funds obviously, and all the individual instruments? How am I supposed to look at my portfolio?
There is enough software available in the market, wherein if you put your whole portfolio, it will tell you how much is your exposure to giants, how much is your exposure to large cap, how much is your exposure to mid cap. As long as you do that, that's fine. But if you have your ESOP, that is one thing which can completely, twist. There are people I see with a net worth of 20 crores, out of which 18 crores would be ESOP. That is not right. But if you don't have an ESOP, there is no question of, you don't have to worry too much about whether you're overexposed to one Reliance or one HDFC Bank or things like that. I don't think you need to worry too much about it. Yes, but that software is available, by which if you put in all your portfolios, let's say you have a ULIP, you have a mutual fund, you have direct equities, and you have NPS, or you have some index funds. So it will consolidate and tell you, okay, 8% of your money is in this company, and 7% of your money is in this company. As long as that does not exceed 15 or 18 or 20%, don't bother. But if you have a ESOP, that skews the whole relationship.
Okay, all right, fair enough. Thanks a lot, Mr. Subramaniam, then, for joining us and, of course, helping out all our viewers with their questions and queries. Well, folks, there you have it. If we've not been able to take your question today, don't fret. We'll always be here. You can always email us on our email address, themoneyshow@etnow.tv. And you can call in as well, 24990300.